Good morning. I'm Tim Nyland, Director of Research at Pacific Point Advisors in Rancho Santa Fe, California. Together with my team of analysts, we've built out a state-of-the-art research lab that will bring you a unique and timely perspective of analytical issues of relevance impacting financial markets. Before we get started, please like, comment, and subscribe, and be sure to visit the Pacific Point Research Lab on our website at pacificpoint.net/research-lab. And while you're there, be sure to sign up to receive our research delivered directly to your email inbox. If you're getting tired of financial experts trying to guess the bottom of the market, or the start of the next bull market, or whether a recession is priced into the S&P 500, this webinar is for you. No opinions here today. We're simply going to explore the charts we use here in our research lab, and I think you'll be amazed at the conclusions we come to. Let's go ahead and get started. And let me turn my laser pointer on. There we go. All right, first slide we're going to look at is the S&P 500 Index PEF12M. So that's a forward 12-month earnings-based PE. And the question again is a recession priced in? And when you look at this, you'll see that as of Tuesday's rally, we're actually sitting above our 20-year median PE. So it's hard to imagine that a recession is really priced in. But you can see why a lot of investors are wanting to say that, because we've had this just tremendous PE multiple contraction literally since the first of the year. So what we've got to do in order to determine if a recession is really priced in is we've got to figure out what exactly is driving this PE multiple compression. First thing we're going to do is we're going to look at the components of that PE ratio. And we're going to do that by looking at one of the charts that we love to use in our research lab, called price and earnings. In this particular view, we use out of Zacks, in this case, for the S&P 500 index. Now, keep in mind that when we look at these earnings, and let me explain here, we've got the price line here in blue for the S&P 500, and we've got the underlying top-down earnings for the S&P 500. And this is going to be a trailing 4 quarters earnings in orange. So these are going to be the top-down forecasts that analysts and strategists make, okay? The only thing I want you to take away from this chart here is the fact that these estimate revisions have not been revised down. So we've had a PE multiple contraction based more or less nothing but price decline against a backdrop of actually increasing earnings, okay? Now, in order to cross-check all of this, we like to look at a lot of different proxies, okay? So we looked at top-down S&P 500 earnings in the last chart. Now we're going to look at the S&P 500 composite, and this is going to look at bottom-up earnings, right? So you can see the earnings levels themselves are much lower, but the growth is fairly consistent with what we saw in the last chart. So you can see this growth trajectory here. And what I want you to pay attention to is what's happened to the growth of earnings during prior recessions, right? We have these earnings troughs, okay? One of the things that we do is we maintain a basket of our own model portfolios to utilize to cross-check the broader benchmarks and to basically do a lot of the cleanup work for the biases that have been introduced into the S&P 500. So the first thing that we do with our industrial model portfolio, and I want you to see how close this resembles the S&P 500. So just look at this chart, price and earnings, just look at the two lines. And as I go to our own industrial model portfolio that we use here at Pacific Point and we maintain, the difference is this is a 400 stock portfolio. So we take the S&P 500 and we literally strip out all the tilt sectors. So all your financials, all your energy stocks, precious metals, commodities, anything like that. We strip those out, anything that's rate sensitive. And we add back a like 150 names, because if you were to do that now, you'd end up with like 250 stocks. So we get to about 400 stocks, and this gives us a really, really good pulse of the industrial U.S. economy. So you can see that we've introduced a little bit of cyclicality into this. And the idea is if you have a really, really good benchmark that's a pulse of the U.S. economy, you could assume that half of those members or 200 members would be more growth oriented and half would be more cyclical or tied to the underlying performance of the underlying economy. And that's exactly what we have, okay? So we have 400 stocks here with the industrial model portfolio. And if we go forward, and again, you can see that cyclicality. I want everybody to see that 12, 6, 12. If we go back to the S&P 500, it's pretty consistent, 7, 7, 8. Okay, so a little cyclicality. If we split this in half, we end up with our Pacific Point growth model portfolio. And again, you can see the same action here, right? price decline in 2022 against the backdrop of increasing earnings. Keep in mind, this is going to be all bottom up reconstructed. So 200 stocks bottom up. And you can see where that multiple compression is coming from. The idea here is that we still don't have analysts revising estimates down if we're going to be heading into a recession. Okay, so where are these downside EPS revisions? So the next basket that we can look at is the cyclical basket. So basically what we're going to do is we're going to take these economic cycles and we're going to exacerbate them, right? Because this is the opposing 200 stocks of the industrial model portfolio that are tied to the business cycle and will exacerbate those earnings troughs. And that's exactly what we have. And why do we do this? Because we want to see what type of indicator the buy side is sending to these corporations themselves. And you can see that there's been no response, regardless of the fact the buy side has sold off this group. Keep in mind, there's no energy stocks in here, right? There's no financials. This is a pure pulse of the industrial cyclical economy, okay? So the idea is the buy side has already priced in these earnings to roll over, but US corporations and the analysts that cover them on Wall Street have not yet thrown the towel in and revised those estimates down. We're just not seeing it. So you can see we're coming out of that earnings trough with solid 17% growth here in 2022. 2023 drops down to 1%. But if you guys have been listening to my webinars, you'll know that that's a normalization process coming out of the cycle. And if you add that 17 to the 1, divide that by 2 for 2 years, you end up with about 9%. So the fact that we're going out to 8% in 2024 tells me that this is just normalization and that those estimates have not been revised down yet for 2023, okay? So the idea is, if that's the case, then not only where are the downside EPS revisions, but what do they actually look like? And this is a table. There's a lot of tables out there you'll see. This one was done by LPL. I really like it. It was actually done in the COVID area, but I like it because it actually goes back to 1945. So it's looking at EPS declines, both the average and the median, going all the way back to 1945. And so this gives us some kind of benchmark for what we can expect when we actually see these estimate revisions or even actuals come in on the decline, okay? So these are actual EPS declines, and you can see that the average was actually a whopping 26.5. I put a red X through that because I just don't even want to think about having an EPS decline right now of 26.5%. I don't even want to model it, but we could certainly do that. We're going to stick to the median forecast, which is probably a little bit more reasonable for the type of recession we're running into, but certainly 26.5, depending upon if the Fed continues and breaks something maybe in the cards. We're just not going to model it. But in a couple of slides, we are going to model the 18% number. So just wanted to give you a benchmark here for what to expect if a recession were to hit. So let's take a look at where the estimate revisions have come in to date. Okay, now keep in mind, the last set of charts that we looked at, we're looking at all of our models and the broad market indices, right? And we're trying to determine if the estimates have in fact come in, and they haven't, right? We're still seeing just massive growth, the growth trajectory continuing. If we're going to have a recession and if it's going to be priced in, when it gets priced, we're going to have, just in terms of a median recession, 18%, we'll just call it 18% decline in EPS, okay? So when we look at the consensus forecast, we're going to do this really quickly. We look at Zacks. So this is going to be the Zacks polling of analysts for their top-down, because this is the S&P 500 index of their top-down FY1 and FY2 EPS forecasts. You can see that we're only up 2.1, okay? I should say that we're actually up 2.1. It's actually not a good thing. We should be down. But this is when the Federal Reserve actually started messaging that inflation was no longer transitory and that they were going to have to start taking action. It was right around this time in the fall. You can see 1031 and 1130 still sitting at 220. And then we ratchet actually up in the face of the need for the Federal Reserve to raise rates, okay? So this, again, speaks not only to the strength of the economy, but the ability for these S&P 500 companies to command price in the face of inflation, that these estimates came up. But now we're actually revised down. So only 2.1 from a year ago. So each one of these is the actual monthly EPS estimate revision. And you can see that since June, we've actually declined only 0.5%. So if we're heading into a recession, you would expect that to be much more. Now, what I want everyone to remember from prior webinars is that the sell side tends to be late revising their estimates down into recessions and tend to be late revising their estimates up during recovery out of recession. So just keep that in mind. We need to model this knowing that information. We're going to do that here in just a minute. But FY2, keep in mind, if we're going to interpolate a forward 12-month PE ratio, we're going to be looking at an interpolated point between FY1 and FY2. There's been no change, right, from a year ago. That estimate was 235 for S&P earnings. It's still 235. Interestingly enough, it's down 2.5% since June. We go to the next slide. If you don't like the Zacks estimates, we'll do a quick bake-off between them and FactSet. Not concerned about the actual numbers. What I want to relay here is the fact that they're about the same, right? We're just not seeing anywhere close to, an 18%, even a 5 or 10% decline in consensus estimate forecast, just not there. So this is the top-down FY1 2022. You can see from the June point here, FactSet versus Zacks. You can see from 1021 or a year ago, FactSet positive 1.4, Zacks was positive 2.1. There's just not much in the way of revision, right? Despite having the most aggressive rate increase in the last, several decades, and quantitative tightening on top of that. So this is just incredible that these numbers haven't changed. This is something that we need to flag as an issue and do more research on, and we're going to do that. So when we look at top-down FY2 2022 or 2023 EPS consensus forecast, FactSet versus Zacks, again, from 1021 to 1022, I mean, there's just not a whole lot of change in these numbers. We did get a little bit of a movement here in the FY2 for FactSet at decline of 4%. You can see that here, the 249 all the way down to the 239, but still nothing in terms of a 10 to 15% move like we would expect if we were heading into recession. You get the same exact results if you look at Zacks on the bottom up estimates. So again, we just take the average of the 500 stocks that make up the S&P 500. You're up 2.6 from last October on F1. On F2, you're up, 0.2, just call it flat. You're 624 to 625. From June, you're down negative 0.7. And on FY1, FY2, you're down negative 2.8. Okay. So estimates haven't come down. The growth forecast really hasn't come down. So we have to ask ourselves again, what's driving this valuation collapse? So if we've already looked at the underlying company factors, then the only other alternative that's left are the macro factors. Okay. So what we're going to do is we're going to look at these macro factors, and this equity risk premium up here, this is the title of this collection of 4 charts. So this top panel is not the equity risk premium. It's equity risk premium here is more or less the routine for these 4 charts. This third panel is the actual equity risk premium. You'll see it says Pacific Point equity risk premium. We actually calculate and maintain this series ourselves. The top panel is actually the S&P 500 index PEF12M. And then the second panel is going to be the 10-year Treasury yield. And this fourth panel is the total equity discount rate. We're not going to talk about this yet. We're going to circle back and talk about it here in just a few slides. But I have it here because it's important. This is what Wall Street uses as their total equity discount rate. And it's simply the sum of the risk-free rate plus some premium just to be exposed to the equity class. These 2 factors plus a company-specific adjustment will equal a total equity discount rate. Okay, and that's what you see here. So what do we want to get out of this particular screen is these relationships, that the explanatory power of equity risk premium to be able to explain movements in the PEF12M is very, very strong. So I have normal market behavior here, or normal macro factor behavior, I should say, trend lined in green. Okay, you can see this massive PE multiple contraction from 2000 all the way to 2011. And then you can see multiple expansion from 2011 all the way up to about 2021. At the same time that happened, you had equity risk premium go, or I should say rise from near record lows and moved to near record highs, which is what compressed that S&P 500 forward multiple. So as investors were requiring more in terms of a risk premium to be exposed to the equity basket of securities, it would make sense that that PE multiple would contract. And then as that equity risk premium came back down, you can see that multiple expand. Now, where the anomaly takes place is, and you have to understand that despite what you hear and read in the press and on TV, that the US Treasury yield, the 10-year specifically, really has no explanatory power for movement in the forward multiple to the broader market. Now, I should say in normal times, you'll see that I have macro factors anomalies up here in red. And you'll see that right now we are in an anomaly period. And the anomaly is that equity risk premium has actually been more or less flat for all of 2022. And this multiple compression that we looked at with all of those charts that we first started with is almost entirely attributable to this change or this movement in the 10-year Treasury yield, okay? So under normal circumstances, it would have been an increase in equity risk premium that would have driven this multiple collapse, but not this time, okay? This time it's being more or less attributed to this change in the US Treasury yield. And you can see that in the 10-year specifically, and you can see that here in the charts. So this is the anomaly we're going to explore here in just a minute, okay? But again, this normal behavior, the 10-year Treasury relationship to the S&P 500 PEF12M is random. I mean, you end up back here in 2000, 2001 with 10-year yields at 6% and PEs at 20, and you've got the same relationship here in 2020 with yields all the way down here at 1.5, and you just don't find that type of a relationship with equity risk premium. The reason why those PE multiples were so huge back here in 2000 is that equity risk premium was sitting at record lows. And the reason why they were so large here in 2020 and 2021 as well is that we were right back to that same record low. Point being, we're still at that same record low. And this is the risk, okay? This is a red flag for us to basically be able to say we need to be careful here, because the current S&P 500 valuation may not be taking into account a recession, because when we go into a recession, I want you to look at the equity risk premium. What does it do? It skyrockets, okay? What would happen if this equity risk premium skyrockets? Well, we're going to look at that here in just a minute. So these are the macro factor anomalies we got to look at. All right, so let's go through this really quickly. The 10-year Treasury's ability to explain the movement in the PEF12M. It's more or less random outside of the points that I've circled here in red. And what I want you to see is that during recessions, the 10-year Treasury yield collapses. You can see that, right? This is the flight to safety, right? What happens during that same time frame? PE multiples collapse. This is going to be a shock to investors if we go into a recession, because everybody's used to the stock market taking off when the 10-year Treasury yield declines. But in real life, what happens when you're in a recession? This flight to safety trade leads to a massive multiple compression. You can see this time and time again throughout recessions. So keep that in mind. When we model this, okay, this is where it gets really important. This is why I say this relationship of the 10-year Treasury being able to explain the movement of the forward multiple, the S&P 500, is just purely random or sporadic. Is if you look at the charts and we overlay these two over one another, you can see that from 2000, the 10-year only explains 2% of the movement in the S&P 500 forward multiple. And you can see that because we've actually run a regression here, and you've got an R squared of 0.02. There's just no explanatory power over the past 22 years of the 10-year Treasury being able to explain movement in the underlying S&P 500 PEF12M. However, look at what's happened year to date, and let's run the regression. Next slide. This is the anomaly. We go from 2% explanatory power to 75% explanatory power, okay? So year to date, the 10-year explains 75% of the movement in the S&P 500 forward multiple. That's because of that rate of change has been so extreme. It's literally just sent shockwaves through the entire market. And we've all seen the effect of that. So what's equity risk premium's ability to explain movement in PEF 12M? Well, if you look at these two series, they're merely a mirror image of one another, right? When equity risk premium spikes, PE multiples contract. And you can see this is exactly what I was talking about when we looked at the prior equity risk premium slide. Look at these spikes in equity risk premium and look at the collapse in PE. So this has the opposite effect of what happens with 10-year treasuries. The risk to the markets right now is that we're not in a recession. Is a recession priced in? I don't think so. It may be. We don't know. But I can tell you that looking at history, if we do go into a recession, you can expect this equity risk premium to spike. So we're going to model this here in just a minute. Okay. From 2000, the equity risk premium explains 76% of the movement in the S&P 500. And that even takes into account the year-to-date period where there's very little explanatory power, like I've said. It still explains 76% of the overall movement in the S&P 500's PEF 12M. That's very large statistical significance. Okay, we need to pay attention to that. The anomaly is year-to-date, this thing has more or less been flat. And equity risk premium is only explaining 31% of the movement of the S&P 500. Okay, so statistically insignificant. We really can't even draw any conclusions from that. Okay, so how does this look if we were to do some factor modeling? And this is purely hypothetical, right, for a recessionary scenario in 2023. First thing I want everybody to do is just take this period of froth and just pretend like it didn't happen, right? The Federal Reserve right now is doing a really good job of mopping up all the excess liquidity. We had it drive equity risk premium right back down to record lows. And you can kind of see where we're at right here. So I've got a lot of little red lines drawn on the screen. We're going to kind of make sense of all this right now, okay? So the first thing I want everyone to pay attention to are these periods of S&P 500 multiple contractions during recessions. I know everybody's anxious for, the Fed to do a pivot, and all you hear about is when's the Fed going to pivot because the market's going to rally. Well, by the time the Fed pivots, we may have already done the damage, and we may already be heading into a recession, or we may already be in one. We don't know. But the idea is that you do get forward multiple contractions in recessions. Okay, and you can see that here as we're modeling the most recent three. And the other thing is that you get a flight to quality in the 10-year. The 10-year goes down during recessions. Everybody piles back into the 10-year, pushes yields down. Okay, so the idea is then why do we end up with a multiple contraction? Because now we're conditioned, right? Before this recession, I mean, if you look at the past couple months, I mean, every time Treasury yields go down, the stock market skyrockets, PE multiples expand. The exact opposite is going to happen when we go into a recession because of this concept of equity risk premium, okay? During recessions, equity risk premium skyrockets, right? This speaks to those company-specific factors that more or less serve to drive that, even though the equity risk premium itself is a macro factor. What ends up happening is as these Treasury yields roll over, right, that macroeconomic headline risk more or less takes place of that rise in treasuries. You get a multiple contraction. We're just literally modeling this out with a red pen here. You get a rollover in the 10-year, and what's going to happen is you'll end up experiencing most likely an equity risk premium increase. Now, depending if we have a mild recession, you might see equity risk premium rise from 5 to 6%. And if we get, a median type recession, one that LPL would term median, you can expect an increase to somewhere between 6 and 7%. And you can just walk back here and look at any period of time where we had a 6% equity risk premium and take a look at what those forward multiples were, specifically during these recessionary periods. It's really important to do that. But the real important point here is that during recessions, what's going to happen here, this total equity discount rate, I told you we'd circle back to this, is that this equity risk premium will likely end up outpacing the decline in the 10-year, which will lead to a continued rise in that total equity discount rate, which is what will ultimately drive this forward multiple on the broader market down further, okay? So that's the important point to remember with these factors when you're considering a recession scenario in 2023. Everything that you've been conditioned for over the last couple months with Treasury yields declining and the market taking off could potentially unravel and reverse itself, as we see historically here through the prior recessions. This is in my opinion. I'm showing you the actual charts, okay? And this is how things tend to work. And you can see the modeling I put in here, you can see this take place during each of the recessions. Again, I'm just saying this will likely outpace this, which will continue to drive that total equity discount rate up. And you can see that taking place here as well, okay? So what are the conclusions, right? The conclusion is that a recession may not be reflected in current valuations. That should be clear now. And the reasons why, there's basically two of them. Low levels of equity risk premium that would likely rise during a recession, right? We've seen that. I've shown you the charts. The second point is that EPS estimates would likely be revised down heading into a recession. I think these 2 points are very, very easy to see how this could be a scenario. And a reason why that a recession it may not be reflected in current valuations. So let's consider the following, okay? So today we used a lot of Zacks estimates and a few Zacks charts. So I just literally went into the Zacks system and I grabbed the EPS F12M on the S&P 500, and it was $232.57. Now keep in mind that is that interpolated point between FY1 and FY2 that we looked at earlier. So if we were to model out a mild recession scenario, and keep in mind this is purely hypothetical, and let's assume that equity risk premium rises to what I said, between 5 and 6%, and let's assume that PEF 12M contracts to 14.5, right? We saw that at the end of 2018 when the Fed finally called off its latest round of quantitative tightening. So 14.7 is what it stopped at. It's pretty reasonable to assume that we could end up with a mild recession at a 14.5 handle on the S&P for a PEF 12M. So knowing what we know about earnings declines, let's just assume it's a mild recession and the S&P EPS F12M declines 8% further. So we're just going to assume that EPS estimates across the board have already been revised. And this is aggressive, but we're going to be aggressive to stay conservative with our valuations, that it's already been revised down 3%. I've got it noted down here. So this would be a total revised down from June of like 11%. That would bring our 232.57 F12M estimate down to 213.96. That gives you a hypothetical S&P target for a mild recession scenario of around 3,100, okay? So if we don't end up in a recession, we keep this volatility going. Could we see 34? Could we see 33? Sure. If we end up with a mild recession, could we see 3,100? Sure. It may not get down that far. We don't know. This is literally just hypothetical, just to give you an idea of how this works, okay? When we start talking about a median recession scenario, okay, equity risk premium, you could expect that to rise between 6 and 7%, right? We've seen this time and time again. PEF 12M, it's really, really conservative to assume that we could see a contraction to 13.5. Sure, if we could get down to a mild recession at 14.5, we could certainly get down to a 13.5 in a median recession. And again, we're using that LPL defined term off that table that we saw earlier, which is about an 18% decline in earnings. That would be a significant hit to the growth. And we're actually going to model that here with that F12M EPS declining 15% further. So again, 15 plus 3 gives us that 18%. That would be 197 off of that, the 232. So 232 minus the 15% gives you the 197.68. That gets us a hypothetical S&P target of 2669. So interesting. So thank you all for attending. That's about it for today's session. If you have any questions or requests, please leave a comment or email us directly at info@pacificpoint.net, and be sure to connect with me on LinkedIn at Tim Nyland. To receive our research, please visit us at the Pacific Point website at pacificpoint.net and click on the Research Lab tab and sign up to receive our research delivered directly into your inbox. Thank you.